Okay, great. We should be live. We should be recording. So if you can hear us and you can see us, feel free to throw a hello in the chat. We'll give it a second just for everyone to kind of come into the room. But we are recording this. You will receive a copy of the presentation. You will receive a copy of the recording. So if you miss the first few minutes of this, no stress. We're just going to be going through disclaimers. But we have so much to cover today. Chad, I think we should just start rocking our presentation so we can get through as much information as possible in the next hour with everyone.
All right.
Okay, so we are back again. This is, I think, my fourth year doing this for the American Women's Club. We are going to be talking about tax and financial planning updates for U.S. citizens living in Switzerland today. And I'm joined by my colleague, Chad Hatala, and I'll let him introduce himself in just a second here. Starting off strong, we've got our disclaimer. So just a reminder that Chad and I are not your advisors unless you've engaged us separately. This presentation is just general advice and may or may not be applicable to your unique cross-border financial and tax situation. So be sure to speak with your own counsel. So that's our disclaimer. And then I'm Ariel Tucker. I'm a U.S. expat as well, living in Switzerland. I've been personally and professionally exploring tax and financial issues for over 15 years. I own and operate Connected Financial Planning, which is a fee-only financial planning firm. And I say fee-only because we are only compensated directly by our clients. We do not sell products. I also host a weekly podcast called Passport to Wealth that highlights tax, financial, and life journeys of Americans abroad. And Chad has been my guest on the podcast before, so we'll be sure to share that episode with you when you receive our follow-up email. I've written for Bloomberg Tax and been featured on numerous media outlets including Forbes, CNN, Yahoo Finance, Consumer Affairs. I'm also writing a book called The Expat Money Playbook, which is coming out with Wiley Publishing this October. So I hope that you will follow along with me and Connected Financial Planning on LinkedIn, Instagram, Facebook, and where I engage almost daily with the broader expat community on tax, financial planning, and general expat considerations. So, Chad, welcome. Thank you for joining me today.
Thank you for having me. My name is Chad Atella. I'm a U.S. tax specialist and also a certified financial planner, although I focus mostly on U.S. tax for expats, inpats, renunciations, and some retirement planning. I'm based here in Rheinfelden, which is not too far from Basel, Switzerland. I got my start in tax 26 years ago in Tokyo, Japan, with one of the big four, and I've been doing it ever since and enjoy doing it.
Yeah, you and I both got our starts in Big Four, which is a great place to see a lot of tax action. So, okay, Chad, we have so much to cover today. We're going to be running through who needs to file, important dates, common issues for U.S. expats, review and kind of overview of Swiss tax. Neither of us are Swiss tax experts. We both know enough from living in Switzerland and working with clients on it professionally. We're very dangerous. We've got some Social Security updates, and of course, we are going to do a Q&A. It's very important that you guys all recognize that this is recorded. This recording will be made public at some point, so please do not disclose any personal identification or issues. That's not for this presentation, but we are happy to answer kind of general questions. You can throw those in the chat. Savannah is joining us. Savannah is also our cross-border tax nerd and fellow cross-border financial planner. She's joining us today to help monitor the chat so we can get through your questions there, and then she'll kind of help feed questions towards the end of the presentation when we have time for your questions. So let's kick things off with who needs to file a U.S. tax return.
Yeah, so generally there's four main categories of people that are required to file. Now, hopefully U.S. citizens are already aware that if they have income, they're required to report their worldwide income every year. U.S. green card holders are also considered U.S. tax residents, similar to U.S. citizens. Accidental Americans is a term we use for basically people who were born in the U.S., their parents were assigned there, and then they left when they were young, only to find out, usually years later, that their U.S. passport requires them to file. Then there are U.S. tax residents. There's what's called a substantial presence test, which looks to see whether you are, well, the requirements are if you're in the U.S. for at least 31 days in the present year, and then it counts 1/3 of the prior year days, and then 1/6 of the second prior year days. And if it is a more than 183, you've met the substantial presence test and would be considered a resident absent any potential treaty or closer connection claims. And then there are those who are not in the U.S. at all and just have U.S. situs income, such as rental properties, or if they have incorrect withholding on their U.S. dividend income, for example.
Yeah, and I think it's really important to mention and I'm glad you ran through what the substantial presence test is. What I see a lot is oftentimes we have one U.S. citizen spouse and then maybe like a Swiss citizen, and they are traveling back and forth all the time, working remotely between the two countries. And it's just important to recognize if that Swiss citizen spouse wants to completely stay outside of the U.S. tax system, then they need to be very mindful of their days in the U.S., those working days.
Well, there's two pieces of that. They need to be mindful of the days for the substantial presence test, but if they're performing services in the United States, then technically the way wages and self-employment income is sourced is based on where you physically perform the services. So if they're spending 20 days a year, then they might have a substantial amount of income that should be reported to the U.S., whether it's on a non-resident or resident filing. And states with income taxes also take the same approach generally. They look to days, and there's usually no de minimis.
Yeah, every state is different here. So I just want to throw that up as one of those orange flags. And when I say an orange flag, it's talk to your professional about your specific situation, because it is something where the facts and circumstances, the real data, is very important, and we can't cover every case, outlying case in this.
I would just add one more scenario, because this people often don't realize until it's at that point. But we are focused on individual income tax here, but where they use the example of one U.S. spouse, one non-resident alien spouse, they think that, well, if the non-resident alien spouse passes away, there's no U.S. filings. But if that non-resident alien spouse owned U.S. real estate or had more than $60,000 in U.S. shares, such as Apple, IBM, then their estate actually would have a non-resident filing requirement. It doesn't necessarily mean that it would owe any tax, but there's still a filing requirement.
That's a great point. And I was just talking about this with another colleague about that estate tax. And we're very lucky in Switzerland that we have a really good estate tax treaty. But again, thinking to our audience tonight, thinking about a lot of globally mobile families, it's just something to be aware of. Not every country has as good of a treaty. And I don't think we have a good tax treaty, but we have a very good estate tax treaty. And those are two separate treaties. So it's just something, again, orange flag, talk to your own counsel about that. The other thing I just want to kind of quickly point out with the U.S. system, which is very different to the rest of the world, is, and I think people are becoming more and more aware of this because President Trump has talked about this, about how the U.S. has that citizenship-based taxation, not residence-based taxation. So if you are a U.S. citizen, you are a U.S. Green card holder, or otherwise considered a U.S. tax resident, you're still kind of tied in to all the U.S. tax rules, even when you're not working in the U.S., none of your income is in the U.S., you have no substantial ties to the U.S., that citizenship or even that green card continues to tie you there. So let's go over to our 2025 minimum income filing thresholds. So we're talking about the 2025 tax year, which is the tax return you're filing now in 2026. And the 2026 thresholds are slightly higher. And I think that's just a quick note on that.
Yeah, I mean, generally, if your income your gross income is below these amounts, then you don't need to file. There's some exceptions, but if you're just a normal worker who has some interest, some dividends, and your gross income is below these thresholds, then you don't need to file. Note, self-employment income, if you go over 400, then technically you need to file. And the reason is the self-employment tax, though if you started your self-employment here, you should be paying into the Swiss system and have a certificate of coverage to show the IRS should they ask that you're not required to pay self-employment tax. And then just a shout out to married filing separate individuals. This is where one's U.S. and one's non-U.S. You have a filing requirement if your gross income is $5 or more. So a lot of people miss that.
Another thing that I see, we're going to talk a little bit, I think, about the Foreign Earned Income Exclusion later in this presentation, but I think it's important to understand that the numbers that we're seeing here on the slide, this is like the total amount. You don't start with the exclusion, and if you end up below this amount, then you're clear. This is like the total amount of income, and for a lot of people, this might be a mix of like wage income, interest income, dividend income, and for Switzerland, these amounts are really low when our minimum wage is what, 60 or 70,000 Swiss francs, right? Most people, if they have a part-time job, are filing a tax return. I don't know where you fall on this, Chad, but like sometimes I'll have people who leave the workforce for like a year to, take a year off to travel or to be a student, and they actually do for like that 1 year fall below the thresholds. Sometimes I will still have them file a tax return just because sometimes the IRS is like, okay, we have tax return information for you every year, and all of a sudden nothing. And we know you got it, we know you got a 1099, we know you got this other information, where's your tax return? And like, just to avoid that, I will sometimes be like, just go ahead and file a return, because we know you're going to need to do another one next year. What's your take?
I would say I usually advise clients to do that if they've told me they're planning on renouncing their U.S. citizenship, because you got to show you've been compliant the past 5 years. Now, by not filing, because you don't have to, you have been compliant, but it's just cleaner to show, here, this is what I made that year, and that's everything. And especially in that scenario, I would usually recommend people to do that.
Yeah, makes sense. And we do have a presentation on March 10th all about expatriation. So if you're curious about expatriation, be sure to register for that presentation as well. Okay, let's talk about some of the important dates. And again, we're saying 2025 important dates, and then obviously you see all the dates are in 2026. So run us through that, Chad.
Yeah, so I get this question all the time. So everyone asks me, when's my return due? So you're required to pay any balances due by April 15th. Failing to do so results in interest from this date forward on any unpaid balances. It's also the date of your first quarterly estimated payment for 2026, the following year, or the current tax year. Now, those of you who are living outside the U.S. as of April 15th have an automatic extension of time to file to June 15th. You can request an additional extension to October 15th, but after June 15th, for those residing outside the U.S., the underpayment penalty also starts to apply. After October 15th, it is possible to send in a letter requesting an extension to December 15th. However, the IRS is under no obligation to accept it, and I've had some maybe about 8 years ago denied. It just seemed like the IRS was testing the waters at the time, but I haven't had any denied since then. But it's possible for them to deny it, and if you file late, then the late filing penalty applies on any unpaid balances. And just give people an idea of what that is. So the late payment penalty is 0.5% per month, and the late filing penalty is 5% per month. Max of 25% of both combined.
Yeah, and I guess a tip here is I always recommend trying to file your Swiss tax return first, right? And I know in the Zurich area, I'm not sure In the Basel area, if it's the same March 31st deadline, and I know so many people do extend that deadline very easily on the Swiss side, but I always say, try to get the Swiss one done, knock that out, because you can use that information and go right directly to your US preparer and kind of try to get that done. Before we hit record today, you and I were talking about, we're expecting, a lot of our clients to see potentially higher balances due this year, and that's simply because the Swiss franc from last year to this year has appreciated by 12% against the dollar. So on paper, it looks like everyone in Switzerland just made more money because we're always converting that back into dollars. And that's kind of a very unfortunate thing for a lot of people because it may push you into a higher tax bracket that you haven't been in before, right? And so we have more dollars at a higher rate to pay to the US. So something to just kind of be aware of. If you're feeling nervous about it, the best thing you can do is do a quick calculation with your tax preparer before April 15th, even if you're not going to be able to file by April 15th. Quick back of the envelope calculation. How much did we make? Convert that to the new IRS rate, which Chad, what is the rate right now for 2025?
I believe it's 0.8305 or 0.8306. One of them is the Swiss number and one of them is the US number.
Okay. Yeah. So get that converted and then you can just kind of do a quick calculation of what that's going to look like for you. So that you're all aware.
Yeah, one thing I do for my clients, which others might want to do as well, so because April 15th is the payment deadline for 2025, it's also the first quarter estimated tax payment. If you make them both as one 2025 extension payment, then when you file your 2025, if there's a little bit more balance due, it'll be covered by that 2026 estimated payment that you included with your extension payment, and then any residual can be applied going forward, and then you just need to adjust the remaining quarterly payments. That way you're covered for 2025, and also you've made your estimated payments timely as well.
Great tip. Awesome. Okay. So let's get into some of the changes. And if you have been paying attention, when Donald Trump came into office, he worked on passing the One Big Beautiful Bill, which did make some changes on the tax side of us. So some of the first changes that we're going to cover aren't from that bill, but Chad has prepared a wonderful handout for you. We're going to send that out to everyone as part of the follow-up with the recording. A few just kind of points to note. We talked a little bit about the Foreign Earned Income Exclusion. That is the amount that you can exclude of earned income every year. I know a lot of people in Switzerland, especially in the lower tax cantons like Zurich or Zug or Schwyz, they do use that foreign earned income exclusion because they simply just never have enough foreign tax credits. So just something to be aware that it does increase for inflation. It's adjusted for inflation every single year. It's a little bit higher now in 2026. We've got also the foreign housing exclusion available. And interest rates are currently about 7%. Those are adjusted every quarter. A few years ago, interest rates were extremely low. And I was telling our clients, you know what, if you owe a little bit of a balance, no big deal. Like the money is basically free. It's like but right now with 7% interest, we are just more mindful between the 7% interest and the appreciation of the franc against the dollar. We're much more mindful that we're likely going to have higher balances due. And so we're kind of making sure we're making those payments very timely. Do you want to run through the rest of these?
Yeah, I mean the income tax brackets. We show that next. So no, we already did that. Or no, we'll show that next. The refundable child tax credit. It's up $200 to $2,200, of which $1,700 is refundable, but only if you're not claiming the foreign earned income exclusion. The gift tax limits have increased to $19,000 for both 25 and 26, and to NRA spouses it's $190 and $194 respectively, and similar to the filing when your income is below the filing threshold. If you are planning to renounce and your doing some planning to get below that 2 million threshold and are gifting an NRA spouse, even if it's at the 190, 194, I often recommend also filing a gift return to report it to show that it was moved from you to the NRA spouse. Just an FYI.
Yeah. You made a good point on the refundable child tax credit. Just, again, something to review with your tax accountant every single year, because if you are in a lower tax canton and maybe you're thinking, oh, I should take the foreign earned income exclusion, but you have 2 or 3 kids or 4 kids, then you might do better off taking the foreign tax credit and getting that additional child tax credit. So just, again, something to be aware of every year when you're filing your return. Really think, am I actually optimizing this filing? Does it make sense? Okay. Then, this is a big one, Chad.
Yeah, this is probably one of the few that will actually impact those of us who reside outside the U.S. So if you're 65 or over, you will get an additional $6,000 deduction, or $12,000 if married filing joint, and this was implemented instead of phasing out tax on Social Security. This was meant to help offset tax on Social Security. So it doesn't matter whether you're receiving Social Security or not. If you're 65 or over, you get this additional deduction. Yeah, that to me, that's probably one of the main ones that impact most of my clients here or in other countries as well.
Yeah, I think out of everything that I saw, and even in the guide that you prepared, that's definitely the most attractive one. And then, of course, we have retirement contributions. I still think the traditional IRA can make a lot of sense for Americans in Switzerland as a way to save for their retirement while also saving on tax, right? Yep. So we do encourage people to do that. The really nice thing about the traditional IRA is, even though we're in 2026, you have until April 15th to make your traditional IRA contribution. So that can still be something that you can leverage this year. And when we're thinking about like, oh man, I got a surprise tax bill, this is another benefit of getting ahead on filing your tax return, so that it's like that is a lever that you could potentially pull to save for your retirement and also save tax. And I always love that. And that's per person. Those numbers, the 7,000.
As long as you're not covered by a U.S. qualified plan, so as long as you're on, for example, you're on local payroll, you're not covered by a U.S. plan such as 401k, you can deduct that, which can save you U.S. taxes. And if you make or if you're someone who wants to make a third pillar contribution, that's deductible on the Swiss side. Then I recommend you also make a U.S. one, so it's largely offsetting tax-wise, because the limits are roughly the same as well.
Yeah. Yep, great points. Yes, this is for those local employees, not for the corporate assignees on expat contracts where you still are paying into U.S. Social Security. You're still getting your 401k. So great point there. Okay, some other changes. I mean, a lot of this stuff I don't think is super applicable, right? We're talking about like the tips and the qualified overtime and like qualified vehicle loan interest. I mean, this stuff is really not going to apply for expats. It's just something.
And the reason why it doesn't apply is it's purely domestic facing. So the passenger vehicle loan interest, the car has to be assembled in the U.S. So, I mean. I don't see anyone necessarily buying a car there and then bringing it over to meet this, and the loan has to be there must be a lien against the car with the loan, so no lender is going to let you buy the car and immediately ship it outside the U.S.
Yeah. Okay. Some more changes here.
Yeah, so on the previous page there was one change, but it will have limited effect for most people outside the U.S. There was an increase in cap to the state and local tax deduction of previously it was capped at $10,000. Now it's $40,000. So if you do itemize, if you do have real estate taxes on non-rental properties, if you do incur some state income taxes, you could potentially itemize if they're significant enough that they surpass your standard deduction. Related to that, there's some provisions around the charitable contributions. Go back to the other slide, sorry. So itemized deductions first of all are now capped at 35% for high earners, and then there's these are actually 2026 changes. So the second item on this slide is also of benefit to most people. So if you do make charitable contributions to qualified U.S. charities, you can now deduct up to $1,000 or $2,000 if you're married filing jointly, without having to itemize your deduction, and that's starting in 2026. So if you have those charities that you normally make donations to, you'll get to deduct them this year.
I was really happy to see that come back. I think we had a provision like that during the COVID years, right? I think it was $500.
Yeah, there's a temporary one for $500.
People loved that, right?
Yep.
Because oftentimes I think it's important to recognize when you donate, and we're talking about U.S. charities. These are 501c3 charities.
Yep.
It's not your local Swiss charities, and these are cash donations, correct? It's not.
Correct.
I donated my old clothing to the Goodwill. It's you gave cash. That's what this is for. But this is just such a powerful way. So many people are donating to their local church back in the U.S. or to their alma mater or the older universities, whatever. They're so generous, and this is a great way for Americans in Switzerland to kind of be able to keep those receipts, and then get a tax deduction, because we know so many Americans in Switzerland always have a balance due. So this is definitely something to pay attention to, but it won't be for the tax return you're filing right now. This is going to be something that you need to do before the end of the year for the tax return that you file next year.
Exactly. And also starting next year, if you are able to itemize, there is a 0.5% AGI floor for itemized charitable deductions. What that means is you multiply your AGI by 0.5%, and that amount of your charitable donations are not deductible.
Yeah, and I don't know if we should go down this road, but I always think like itemizing when you are an American abroad is a little bit trickier, right? Because of these magical calculations to ensure that you don't double dip tax benefits between foreign tax credits or foreign earned income exclusion and then itemized deductions. And so, yeah, it's just something to be aware if you are thinking about making some really serious donations, running the numbers ahead of time if you're counting on that to be a tax impact for you, because there is just such a common misconception that, it's a dollar for dollar deduction every time. And that's not how it works at all. So if you suddenly want to contribute, donate $10,000 or $20,000 or $30,000, it may not actually have a material impact on your tax return. Like, I hate to tell you. So it's something that you want to be planning if you're giving more than the $1,000 to $2,000 for sure.
This middle one, it's a little bit highlighted, the remittance tax of 1%, just because a lot of people got worried about it. This does not impact if you are using normal financial institutions. So if you're sending money from Wells Fargo to your UBS account, this does not apply. This is more if someone goes to Western Union and sends money overseas, then this 1% remittance tax will apply. So if you use the normal financial institutions, this will not apply to you.
Yeah, there was so much press about that last year, and it's really, again, it's not so much for Americans living abroad. I think it was almost like targeted towards immigrants sending money back to like third world countries, which is, I don't know why we're targeting that, but I have not seen it impact our clients at all.
Yep. I don't know if these other two will be that material. I mean, the Trump accounts for children, the government will, if they're born, I believe it's in 2026 or after, you can set up, it's somewhat like an IRA in a way that you can contribute a $5,000 annual contribution, and the government will match the first contribution or up to $1,000. Employers are also allowed to contribute, I think, up to $2,500 a year, but I mean, we're based outside the U.S., so I wouldn't really expect that to be a thing.
Yeah, one of the things I'm curious about is, did I see some press about maybe the Dell family was going to donate on top of this? I don't know if other people are going to come in. For me, if you're planning on having children over the next couple of years, regardless of your political affiliations, I would still be opening up these accounts if you can, and maybe working with a relative in the U.S. to open up these accounts, because free money is free money, and if your kids are being born U.S. citizens, they're going to have to eventually file all the stuff. You might as well get the free money when they're young, between the child tax credits and these accounts. So. Okay, and very quickly on the 529 accounts, we do talk a lot about that with clients, because there are over 350 non-U.S. institutions listed on that. So if you think about ETH and EPFL and a lot of other top universities in Europe, those universities do qualify for using the 529. So obviously, education expenses here are significantly lower than they are in the U.S., so you don't want to necessarily overfund them, but you do have a lot of flexibility in how you could use them, and it could still be a very good planning opportunity for families living in Switzerland. One thing to note, it's not going to be recognized in Switzerland, so it is something that's going to end up on your potentially on your wealth tax return, but again, you can think about who owns those accounts. Maybe it's grandparents who are actually owning the accounts in the U.S. and kind of plan about it that way. I don't know if you have any other thoughts on the accounts.
I think you covered the key points on that.
Okay, great. Okay, we are, I threw the slide in because we had it in last year, but I think it's just important to be aware that we are at a 25 staff reduction compared to last year. So last January to this January, 25% of the staff has been cut. So it's just something to be aware of as you go into the tax season. In my own situation, I had to file an amended tax return last year, and it took, I think, 8 months to process that. So that was a very long and painful process. If you have to call the IRS for any reason to get an update on anything, or you have a question, I always like to call them first thing in the morning, and we kind of have that ability because of the time zone difference. So take advantage of that and call them when they open. I think they open at 7 a.m., right? East Coast time? Maybe you don't know.
Yeah, I think so.
Yeah, 7 or 8 East Coast. So you can call them first thing in the morning if you do have to call them. The other thing that I always like to remind people of is the ID.me account. You can create the ID.me account, and actually we can put that right in the chat. You guys can open that. We have an article on our blog that talks about the ID, like how to actually set it up. We recommend every U.S. expat set that up, because then you have access into your Social Security account, into your IRS account, all of kind of the U.S. government infrastructure that you want to be able to pull reports from. That's how you access that. It's a bit of a pain. I think as Chad and I experienced setting up those accounts on our own, it's a bit of a pain setting it up for the first time, but once it's set up, it's ready to go. So we're currently in a partial government shutdown right now. We may have more government shutdowns. I don't know. That may also have an impact, just so that you're aware on how the IRS operates. Anything else to add here, Chad?
Yeah, just a general comment. If you do have something you're trying to resolve with the IRS and you give them a call, and the person that's helping you is not being that helpful or says something can't be done, you might just want to hang up, call again, talk to the next person. Some of the best and brightest people who used to work at the IRS are no longer there, and yeah, it's amazing how some conversations can go. I had to explain to one agent that credits reduce tax, they don't increase it, and they insisted that according to the line instructions that the credit increase the tax. So hang up, dial again. Yeah.
Yes, I remember we had one audit when I was at PwC, and we had to basically explain how international tax worked to the auditor, because I think it's just such an important reminder that we work in individual taxation, right? And then within that is kind of international. And then within that is every kind of country and the treaties and all the different, little unique things about each country that Americans are living in. So it's like very specialized knowledge, and not even your hometown accountant in Idaho probably doesn't know some of the stuff that we work on and see on a regular basis.
Exactly. I was going to say, I have one more short story to share just because I think I have a lot of clients this impacts. There's maybe some listeners that this impacts. So we go back to the scenario where one is a U.S. spouse and a non-U.S. spouse, and they have a child, non-U.S. child. But the U.S. spouse pays for more than half the living expenses of the child. That U.S. spouse can now file as head of household, even though the child isn't U.S. and doesn't have an ITIN or Social Security number. You have to paper file, but you can still file as head of household. I've been doing this forever, and one of my clients got a notice saying, we changed your filing status to single because there was no Social Security number on there. I spent nearly all day one day on the phone with the IRS. Every agent said no because it's not a qualifying child or not a dependent. I said it doesn't have to be a dependent, it has to be a qualifying child. There's a difference in definition. They would transfer me over to legal. Legal would confirm that what I said was accurate, but then they would transfer me back. The next person would say, no, it's not a dependent. I said, I agree, it's not a dependent, but it is a qualifying child. And I asked legal, I said, can you not just communicate with them? They said, no, we don't have that function, so you'll have to argue yourself. So in the end, I sent in a written explanation of the tax law. Even though I walked the person through, it's in the filing instructions, everything is there. And I still haven't heard back, and it's been 6 months.
Oh, wow.
I got a notice saying we need another 3 months to look at this, so yeah. The IRS has never been the most streamlined of services, but it's taken some hits recently, and I don't see it getting better anytime soon. So you have to have a little patience, and don't blame the messenger.
Yes, yeah, exactly. We're not the ones who are making the rules. This is also why I don't file tax returns anymore. I leave it to good people like you for that work, Chad.
Yeah, thank you.
Okay. But that was a really good point about head of household, because I don't think we even talked about that when we were going through the different filing options. And we did talk about, a U.S. person being married to a non-U.S. person. So that would be either single or head of household if you have qualifying or dependent children, right? And so many children are automatically U.S. citizens if they have a U.S. If they qualify because of a U.S. citizen parent who is able to pass on citizenship. So just kind of, again, if you're in that situation, married to a non-U.S. person, married and have children, it's something to talk about your preparer, because that head of household filing status is significantly better than married filing separately. Married filing separately is really almost like a punitive filing status.
Yeah.
Okay, so when we talk about building wealth as an American in Switzerland, I always like to remind people to weigh both the U.S. and the Swiss implications. So right now I'm seeing a lot of social media posts from all my Swiss tax preparer friends who are going on about all the potential tax savings that we have in Switzerland and all the things that you can itemize and optimize on the Swiss side. If we over-optimize in Switzerland, we have less foreign tax credit, and then we basically just pay the difference on the U.S. side. So it's just very important to be aware of your own financial situation. If you are taking if you're not making that much, you're taking the Foreign Earned Income Exclusion, and you really have no liability on the U.S. side, then you can talk to your preparer about optimizing and maybe itemizing more on the Swiss side. But if you're one of those people who owes $20, $30, $40, or $50,000 every year to the U.S. government, it's basically a game of choose who you want to pay. Do you want to pay the tax to Switzerland, or do you want to pay the tax to the U.S.? We talked a little bit about this before we hit record today, Chad. But I always tell people to kind of really think through, IRAs, which are like the U.S. qualified version of saving for your retirement, either traditional or Roth, Pillar 3s, and then Pillar 2 buybacks. We hear a lot of water cooler talk in Switzerland about doing Pillar 3, which is essentially kind of like how our IRA operates, right? You save an additional amount, and that's tax deductible in Switzerland. It's not tax deductible on the U.S. side. And then also same with Pillar 2 buybacks. if you do either of those things too aggressively, right, you'd make massive Pillar 2 buybacks, that's going to have a huge impact on how your US tax return is going to look because of the differences. Again, Pillar 2 and Pillar 3 is not qualified for US tax purposes. But if you're planning on being in Switzerland for a very long time, maybe it makes sense to still take advantage of those things to kind of give you some security. If you're only here for a few years, you're moving back to the U.S., it's probably not something that I would want to dabble in. It just makes your filing potentially more expensive and a little bit more complex. Chad, I know you have thoughts, so weigh in.
No, I know you said it exactly. I was just going to add the two things that catch most clients off guard, that, why did my U.S. taxes go up so high this year, was, as you said, second pillar buybacks, also improvements to their Swiss property. So the improvements to Swiss
That's
property.
gone away now.
Yeah, in 2028, I believe, or 2027.
Yeah.
But yeah, that has hit so many of my clients. They say, why do I owe more this year? Well, you made 150,000 improvements to your home. You deducted on the Swiss side. You just don't have the credits now on the U.S. side. So just take those into consideration when doing them. But yeah, the third and second pillar buybacks, if you're planning on being here long term, they may make sense. You just need to go into it with your eyes open and know what the impacts are going to be and how to go about it. So don't do the buy-in all in 1 year. Well, it depends on the year. If it's a low tax year, you may want to do it. But I recommend get advice, do some projections to show you how it will look.
Yeah, yep, absolutely. We also talked a little bit about foreign investments, and those can appear, like, for example, on your Pillar 3, like, right, you put money in and then you want to put that money to work. What can you put that money to work? A lot of times we end up with PFICs, right, passive foreign investment companies. These are oftentimes like foreign mutual funds. And when I say foreign, I'm talking about anything that's non-US. So that's just something to be aware of. Like Chad and I were talking about before, sometimes it may be interesting to purchase one of these funds and do a special election on your tax filing, which is called a mark to market. I will just say, this is like advanced tax stuff. Like, this is not like I'm going to DIY my own tax return. This is like, I'm going to work with the right professionals to make sure that if I do this, everything is being reported correctly. So you potentially could invest, but then we just have to report it in a different way on the U.S. tax return than we would if they were like U.S. investments where you receive a 1099.
Yep. And an easy way to tell whether a fund or an ETF could potentially be considered a PFIC is to look at the ISIN number or ESIN number. It's ISIN. If it begins with anything other than U.S., then it's highly likelihood that that's a PFIC.
Yeah. And I'm just pulling, we've got a great article on this as well. So I'm going to pull that and put it into the chat as well on just kind of helping to understand, like, what is a PFIC, because we get a lot of questions on that. And this is like a great example of like how Americans are actually walking and living in Europe wearing handcuffs, right? Because we play by completely different rules, right? So we're like, okay, well, we can't really do the Pillar 2 or 3 contributions in the same way as everyone else because it may just increase our U.S. tax liability. And we can't just like go open up a local brokerage account because we're just going to own a bunch of PFICs, which is going to make our tax filing very complex. So it's just something that you have to be aware. I am walking through life in Switzerland wearing financial handcuffs on my little tightrope. What are the rules? Play by the rules and keep your situation simple. And if you don't like that, come to the talk on March 10th on expatriation and we can talk about what that potentially looks like. Okay, let's talk a little bit about if you're listening and you're like, wait, I haven't filed any tax returns ever. Chad, walk us through what that looks like.
Sure. So if you've never filed a U.S. tax return, or at least never filed after leaving the United States, then you may qualify for what's called the streamlined foreign offshore filings. In order to qualify for this, you must show that you are not willful. And willful could mean as simple as you knew you had to file but didn't. But if you're unsure, feel free to talk to me or your U.S. tax professional, because we can walk you through this. But generally, you must have met basically the PPT, or sorry, I should say physical presence test, or BFR, for at least, or physical presence has for at least one of the 3 years that you didn't file. One of the 3 late years, I should say. So we're not talking about 2025, we're talking about 24, 23, and 22. And as long as you meet those conditions, you would have to file the last 3 years of late returns and the last 6 years of late FBARs, which is the report of FBAR, I call it FBAR all the time. Report of foreign
bank account reporting.
Yeah. Your foreign accounts, you have to report the balances. And by doing that, the benefit of this program is that you still have to pay any tax liabilities that are otherwise due and interest, but you avoid the penalties that could potentially apply. And with the late payment, late filing, that can really add up quickly. There is one other program if you were a U.S. citizen but gave up citizenship already and never filed. There's procedures for former U.S. citizens, and the requirements are similar to these, with the one additional one that you have to file the 5 years of returns prior to your renunciation, and the total balance due must not exceed $25,000. And if you meet that, you don't have to pay anything. You just file the returns and the 6 years of FBARs.
Okay, awesome. Thanks for catching us up on that. Okay, so we already talked a little bit about kind of the FATCA compliance. Foreign Account Tax Compliance Act, FATCA, that again kind of creates this handcuffs where many non-U.S. financial institutions may limit or restrict services to U.S. citizens. So like you can go into a bank, any bank in Switzerland at this point, and you can open up a bank account. Like that's not an issue. Whether you're able to invest or get a mortgage or have access to other services remains an issue for a lot of Americans abroad. Honestly, I think it just kind of creates a wealth barrier where a lot of firms are like, we're happy to deal with all the compliance if you have a net worth of over $5 million. We're happy to help you navigate that. But if you are kind of just getting started in your financial journey, that creates a lot of barriers to try to navigate that. We talked a little bit about PFIX already, so I won't spend any more time on that because we have a few more minutes before we want to have some questions. Quick overview of the Swiss tax system, because it's very similar. I mean, it kind of really is similar to the U.S. system in the way that it is progressive. In the same way that the U.S. taxes on global income, Swiss tax residents are also taxed on global income and assets. And then non-residents are taxed on Swiss source income only. Kind of like in the way that we have the state tax or local tax and federal tax, same thing that we have here. In Switzerland, we have the federal level, the cantonal level, the municipal level, and the bulk of your tax is coming from the cantonal and municipal level and not the federal side of things. Very important to just be aware that there's no capital gains on tax on investments, but we have a wealth tax in Switzerland, and that wealth tax rate varies wildly depending on where you live. So where we are in the German-speaking cantons, it's relatively low, but it can be quite high heading towards Geneva. And this kind of, again, it creates tax differences between the U.S. system and the Swiss system, where we pay our wealth tax in Switzerland and we pay capital gains tax on the U.S. side, and there's no credit for those, right? They're different taxes, and so that's kind of is it double taxation? Kind of. It's really just different taxation, and we have different taxes.
For high net worth individuals, the Swiss wealth tax, if it's largely on investments, it can be deducted on Schedule A if you itemize, but for the unfortunately vast majority of people, it's spent and gone. Yeah,
great point. Okay, I also have had this come up in a few times where people were unaware that they had to report U.S. investment accounts on their Swiss tax filing. So just so you're aware that the reporting goes both ways. And the banks and financial institutions are talking to each other at this point, right? Everyone is kind of becoming aware of what everyone else is doing. And just like how the US has a streamlined program to kind of come into compliance, Switzerland also has one. So if you're like, oh crap, I didn't realize I had to report that on my wealth tax in Switzerland, just be aware that you can talk to your Swiss accountant about kind of coming into compliance on that side of things. What else do we want to say here? Anything else?
Well, I would just point out to everyone, if you have a separate Swiss and U.S. advisor, send them both an email allowing them to talk to each other on your behalf, because I've come across many returns where the Swiss advisor really didn't do anything wrong, but it resulted in some incidents of double taxation because they just weren't aware of like the treaty or some other things. So some of the common areas I see are U.S. Social Security recipients in Switzerland. They're only supposed to tax 56.6% of it, not the entire amount. And generally, there is no credit on the U.S. side unless the rate goes higher than 15% of the gross. So for most of my clients who receive Social Security, whatever they pay on the Swiss side, that credit just kind of goes away. So you don't want to be paying more on the Swiss side if you don't have to. The other is dividend income, especially U.S. dividend income. So Switzerland is supposed to give you a credit. What I often see though is either the Swiss side doesn't take it or they think it has to be withholding, but U.S. citizens don't have withholding. So what they'll need from the U.S. provider is a calculation of how much of their U.S. income tax relates to the U.S. dividend income so that they can claim a credit on the Swiss return.
Yeah, great points. And that's the form, what is it, the D1A?
DA1.
DA1, yeah, DA1.
Yep.
Thank you.
On the Swiss side, yep.
Yep, that's the form you're looking for. So if you have U.S. investment income, you want to make sure that the DA1 is always included in your tax filing as well. Great. Okay, I'm kind of flying through these because I want to make sure we have enough time for some questions and just kind of open it up to everyone. We talked a little bit before about the totalization agreement. We also, you and I did the podcast episode, and I'm going to send that on as a resource because we did have major tax reform in January of last year where we had the Social Security Fairness Act passed. And so people who were in retirement or retiring last year did and will receive a bump in their Social Security payments. So just something to be aware of. And I'm kind of like running through the pillar. Again, we have a separate presentation on March 17th where we're going to go a little bit more deep dive into the first, second, and third pillar system and kind of compare and contrast that to what the U.S. System looks like. Just so if you want to do a deep dive on that, be sure to join us for that presentation, which will also be recorded. I think my main point on the Social Security the Pillar 2 in Switzerland is just kind of understanding how the U.S. versus the U.S. sees taxable compensation. So if we're looking at someone who makes $100,000, we see in Switzerland, okay, Pillar 1, so your Social Security is deductible in Switzerland. Your employee contributions are also deductible in Switzerland, and your employer contributions are not taxable. And so our overall total compensation, our starting point for calculating our tax due in Switzerland, is significantly lower than if we go over to the US side and we see, okay, we've made 100,000 Swiss francs, which also needs to now get translated into dollars. We don't get a deduction for our Pillar 1 contributions. Our employee contributions are not deductible. Our employer contributions are deductible. All of a sudden, before we even apply that 0.83 percent roughly, we are already making significantly more income, 30,300 Swiss franc difference between these two calculations. So it's just important to understand there is a difference in the calculation, even though some of like the principles between the U.S. and Swiss system are familiar to us, how we're actually calculating the tax is completely different.
Yeah, and the most common error I see when people are preparing their own return is they're unaware that the employer contributions and gains are currently taxable in their second pillar pension. But just to let people know, because they're being taxed now, you do have basis in that second pillar pension. So when you do take the money out, you will get that portion back tax free. So you kind of need to track that.
Yes, and I know that's something that we do for our clients every year as we're tracking that. Is that something that you do for your clients?
Yeah, I do that every year. I keep a running total and give them a
And
little letter.
just like pro tip for everyone listening in, that's like an interview question. When you're going around and you're talking to different accountants, do you track this? Do you provide me with that information every year? Because it's very important that especially if you work in Switzerland, 10, 20 years, at some point we're taking this money out and we want to make sure we don't end up having to pay money back to the US again on that same income. That's very, very important.
Exactly. And just to throw this in, somewhat related, because a lot of people aren't aware of it, if you have a traditional IRA and you've been making contributions for a number of years, especially during years where you were employed in the U.S. and so you couldn't take a deduction, you should have a Form 8606 in your income tax every year tracking the basis of your traditional IRA. This is the most overlooked form that I've seen in people's returns.
Okay. We're down to the last 5 minutes, so I'm going to open it up to questions. Savannah, do you just want to go off, open up your mic and kind of give us some of the questions that came through, and Chad and I will answer it. And just a quick promo, I would love for you to connect with me. I've got our QR code, so you can follow us on Instagram. This is for our podcast, Passport to Wealth. And then also we have another QR code so that you can follow along on YouTube and watch our podcast there as well. So Chad or Savannah, why don't you read some of the first questions that come through and we'll answer them.
Yes. So the first one is, do you still have to file an FBAR if you are below the threshold for filing U.S. taxes, so below the standard deduction that we talked about?
Yeah, so the filing requirements for the FBAR is if the aggregate value of the max balances of each of your foreign financial accounts exceeds $10,000, then you have to file. So it's independent of the filing requirement for your U.S. tax return. Excuse me.
Yeah, and that's filed with a completely different. That's filed in it's a separate filing from your tax return.
It's a separate filing, correct.
Yeah.
And just to give you a simple example, because that aggregate balance confuses people, if you have 3 accounts and the first account has $4,000 in it and the other 2 are empty, you move that $4,000 over to the next account, and then you move the $4,000 over again to the third account. The max value of each of those accounts is $4,000. Which added together is $12,000. So now you have to report all the accounts on the FBAR.
Yeah, and
so
I just
double counting
if you have that Swiss rental deposit account.
Yeah, the meet cautions account.
With 3 months in Switzerland, you've triggered it. Just assume that you've triggered it and go ahead and file it. Another thing that trips people up is, they want to have a joint account with a non-citizen spouse, and it is an account that you then have to report. Like, even if you have access to the account, that still gets listed as well.
Okay, the next question was the savings account for babies, so the Trump accounts, born is like the threshold if they were born in 2026 or 2025. And Ooh. I did some additional research. If you want me to tackle this one, I'm happy to.
Yes, please.
I don't know off the top of my head.
I think it's 26.
So it's actually 2025. So the $1,000 that contribution that they'll make to the Trump accounts applies to children born between January 1st, 2025 through December 31st, 2028.
Awesome.
Gotcha.
Thank you, Savannah.
The next question. I am planning to retire within the next couple of years and will begin receiving my Swiss employer pension. Will these pension payments qualify for the Foreign Earned Income Exclusion or foreign tax credit when I file my U.S. tax return?
Yeah, unfortunately they don't qualify for the Foreign Earned Income Exclusion, but to the extent you pay Swiss taxes on that, you can claim those as credits. Once again, I would say, if you have been using someone, see if they know what your pension basis is. Otherwise, you kind of got to go back and determine your basis, because maybe not the entire amount is taxable on the U.S. side.
Yeah, and this is, I think, always a hard conversation because we have these major differences between, again, going back to that, that little Excel spreadsheet that we have where it shows the differences between how the US is calculating net income versus how Switzerland is. Switzerland has all these incentives, right? Your Pillar 1 contribution is deductible. Your personal contributions to your Pillar 2 and 3 are deductible, and you haven't paid any tax on your employer contributions. So they've really tried to incentivize you saving and preparing for retirement. The US, unfortunately, is not doing that. You're paying tax on that income all along. But if you retire in Switzerland as a US person, all of a sudden, like that generosity, right, all those tax deductions, they don't exist. Now you have to start paying tax in Switzerland on all this income that has not been taxed. So we start having all of these foreign tax credits. But then on the US side, if you've been tracking and doing everything correctly, you've already prepaid all the tax. You don't have any additional tax. So again, this goes to a major tax timing difference. And this is where I say retirement is something you really have to be thinking about very intentionally, because you don't want to start taking all these distributions and maybe you're like, oh, maybe I'll be here for a couple of years, maybe I'll leave. I mean, you want to be really, really intentional, because for people who do leave and maybe go back to the US, they can potentially take a lump sum distribution on their Pillar 2, and they can show the Swiss government, hey, I no longer live here, I'm no longer resident here, and I have already paid all my tax to the US and I don't owe you any more tax. Please give me a refund from any tax that I paid. So it's something that you need to be very, very intentional about to avoid double taxation. But some people who retire and live in Switzerland for the rest of their life, unfortunately, are just going to end up with double taxation because of tax timing differences.
Okay, we have 2 more questions. I know we're at time, so maybe we try to speed through the next 2.
Okay, sorry, yes.
Okay, so if you filed 1 year because you were over the threshold and the following year you did not meet the threshold to have to file, do you still need to file a tax return because you have filed in the past?
So the short answer is no, but as we kind of discussed earlier, if you're planning on giving up your citizenship or green card and you have to show that you've been applying for the last 5 years, I would recommend just filing it, even though you're not required to, just to document that everything's been done.
Okay, and the last question, is there any way we can contribute to U.S. Roth or 401k accounts from Switzerland, assuming Swiss, not a U.S. employer?
Yes, so with a caveat. So you can contribute to a Roth, but there's income limits, so be aware of that. You can contribute to a traditional, but if you're claiming the Foreign Earned Income Exclusion, you can only contribute if you have income above the exclusion, earned income above the exclusion.
Yeah, the other caveat is Switzerland does not recognize Roth IRA accounts, so this now goes on your wealth tax. So again, we need to be really intentional. Are we in Switzerland long-term, short-term? Why are we putting this money here? How does that fit into the rest of our financial overview?
I'll just add, I think the default is 401ks, IRAs are generally not included in wealth, but then when you take a distribution, they will be taxed here in Switzerland. I have seen people who were close to retirement, they knew what the default was, and they got tax rulings that allowed them to include their IRAs and 401ks in wealth tax because they knew they were going to retire in 1 or 2 years. So it gets taxed as wealth, but no income tax. So that was a huge tax savings for them.
I think that could be really interesting, but again, we still have to think about the U.S. side. How is the U.S. going to tax it? Someone is likely going to tax it, and I have seen vastly different cantonal differences on U.S. retirement accounts. So this is where either you need to speak really good Swiss or French German and tackle it on your own, or make sure you have the right Swiss team in place that have seen U.S. accounts and
Yep.
know what they're talking about and understand, because there are rulings on this, right, at the
Yeah.
cantonal and federal level at this point. So you really need to work with someone who understands both sides. Anyways, on that, I'm going to let us go, Chad. We did a great job. So thank you so much for joining us. I hope to see you at more events. And yeah, we'll have a good night.
Right. Night, everyone.